Hello everyone, welcome back to another Lumley trading live stream. Again, we have the FOMC statement and federal funds rate being released in about 3 minutes from now. Again, forecasted a 25 basis point hike going from 5.25 to 5.5%. Now, again, we said that's what we're estimating. That's a 98.9% chance we see a 25 basis point hike this meeting. So again, in the release in about 2.5 minutes. The last time we've not done as expected was June 15th, 2022, and that's where we hiked 75 basis points compared to the estimated 50 basis points. So again, more than likely you coming in line. Very rare that we ever do or diverge from the estimated, but again, that's always a possibility, and if so, that is always going to be a big trading opportunity. Again, if it comes out higher than expected, then that's always going to be short the market or the stocks. And if it comes in lower than expected, so basically if we pause, then stocks should jump. So that's what we're looking at. Again, if it comes out in line, a bit more of a gamble which way it will go. So I have a different trading strategy for that. Again, the one we look to basically trade every single time, and that's looking at the options. So when I'm looking at it, I'm normally looking to trade the SPX. But again, anything can be traded, SPY, whatever. You're looking at, well, what I do is I look at whatever the current price is coming into the close or the start of the 2 o'clock candle. And let's say we open at 4,556, then I'm looking at the strike closest, so 4,555. I open both the calls and the puts, and whichever one goes down 50% first is the one I look to buy. So that's what I'm looking at coming into this release. That's how I'm looking to trade it. And now we have a minute until this release. So that's going to be the key thing. Again, we will have Squawk playing in the background. So again, that will shout out all the numbers and everything that we need.
So 1 minute remaining now for the US rate decision and rate statement.
There we go. Again, that's the Squawk that will be playing while we're looking at stuff. I'm going to quickly open up a spare chart. You won't be able to see this one because I think those ones are probably more key to be paying attention to for your side. But I will just be watching the options, obviously, from my side, so I can see basically how the options are moving. Just getting that chart set up. There we go. Okay, we have about 20 seconds till this release now. Okay, we got 10 seconds.
10 seconds.
It looks like we'll be doing the 55 calls and the 55 puts. That's what I'm paying attention to on the SPX trade. Buy alert's gone off, hit into the
hike
downside.
25 basis points, hike 25 basis points, hike to 5.5% as expected. So seeing the Fed here, they're saying the banking system is sound and resilient. The Federal Reserve raising the key overnight rate by that quarter point as expected. Will continue to assess additional information and its implications for policy. The Federal Reserve Federal Reserve says inflation remains elevated and policy setting committee remains highly attentive to the inflation risks. Fed says it will continue to assess additional information and its implications on policy, and adding that they are strongly committed to returning 2% inflation target.
Okay, there we go.
Fed does add that it will continue to reduce its bond holdings as described in the previously announced plans. And Fed says the recent indicators suggest that economic activity has been expanding at a moderate pace versus a modest pace. That was said in the June statement.
Okay.
Fed also says that tighter credit conditions are unlikely to weigh on economic activity, hiring and inflation, the extent to which remains uncertain. Fed says the vote in favor of the policy change was unanimous.
Again, no.
Let's look into the market reactions here. Just a whipsaw on the S&P 500.
I got that bit's fine. Okay, that is key. Okay, they said it's unanimous. Remember, we saw this before, and then when they came out with the statement, so I think we have to wait 3 weeks for that. It came out and it wasn't. So as soon as you see that, that's why last time we then ended up seeing the market get battered. So we were paying attention in 3 weeks when we have the minutes released, the FOMC meeting minutes. because if it comes out and says it isn't unanimous, again, we're going to have a big movement. So these are the key things we want to be noting for that next release.
Change noting here is that the recent indicators suggest economic activity has been expanding at a moderate pace. So the language used in the last report was a modest pace. But for anyone interested, we have put out the full FOMC rate statement on the feed.
Okay.
So as this data digests, just seeing some strength in the S&P 500. It's just pairing some of its gains. So it's up around down around spot 4 on the session now.
Yeah, so seeing strength in the S&P, so we're seeing strength in stocks, we're seeing strength in the bonds, we're seeing weakness in the dollar.
US interest rate futures put the chance of a Fed hike at 18% in September, 36.5% in November as well after that statement. So to repeat that, US interest rate futures are putting the chance of a Fed hike in September at 18% and 36.5% in November.
Okay.
US Treasury yields are dipping after the Fed rate decision there. 10-year yields last at around 3.811%. Sorry, that's 3.881%.
Again, still getting ready for the trade. I'll show you exactly what I'm looking at. So calls and puts. We got the
This
SPX.
stream is sponsored by Tick Strike.
So we got the SPX options open. Again, the left right is the puts. These ones are the calls. All I'm waiting for them is to sell off 50%. When they do, that's my entry. So I'm looking at around an entry of about 650 on the calls, and on the puts about the same price again, as we should. Looks like as of right now the puts are more likely to fill, but again, we'll see when it happens. I don't set the order out as a pending one. I will hit it as a market as it comes down, because sometimes you smash straight through, and if so, I want that better entry. But again, that's my trade plan coming into this.
Had dropped to 18% after that. And in November, it was 37.3%. It's dropped now to 36.5% after this statement.
Okay. Not seeing much move on the actual stocks. Again, we still got the ones from earnings. So we got Microsoft, Google, Snapchat, not moving that much off the news. But again, obviously the main focus is going to be over on the
US
futures.
2-year yield falls to around 4.883% after the Fed. So the 2 and 10-year curve inversion lasted minus 101 basis points.
Okay. Still holding up the strength quite well. Again, we got that normal reaction. These are the things we really want to be noting, because these are trading opportunities. How did we react on the SPY? How did we react on the futures? Again, basically going to move the same. We saw that same thing though. We got that fake out direction. You get the fade. So again, that can always be a trading opportunity. They can be a bit harder because where do you put your stops? But that is definitely something to look in for. Again, you probably won't see mega moves now until about 2:30. So if we can continue trending, that's when my trading opportunities will come. What I mean by that is, again, if we kind of zoom in, this is just a 1 minute chart. We'll go from about 1 o'clock. So obviously we're holding. This is where we opened, and this is where we are now. As long as we can kind of continue this uptrend, we should be able to get that put entry. So we'll see how that is. If not, again, we can sometimes wait until 2:30 when we get the conference come out, and that's going to be the biggest volatility. Again, the rate, if it comes out in line, we're never going to be super volatile. The main volatility will come on the conference, which again is at 2:30. So we still have about another 25 minutes until then. I'll do that as the zoom in on the SPY. Now showing a bit of weakness. Okay, faded that move basically.
So again, just reading into the Fed statement here. So it did say the Fed are to consider the extent of additional firming in order to curb inflation.
Okay. We'll go through the key parts again. Squawk's reading it out, but we will go through the key parts. I guess in a bit. We'll let this news settle down a tiny bit and then go through it. But just to cover actually so far the key parts, I guess. So again, rates came in as expected, 25 basis point increase. We have the key parts of the statements. We will continue to assess additional information and its implications for the policy. We then also say, yeah, everyone agreed on the vote. Again, that's going to be more key when we come to the meeting minutes. If everyone did not actually vote on it, or not everyone was in favor, there is, I guess, a bit of opposing opinion coming in the meeting minutes. That's going to be a great trading opportunity, most likely a short bias one. Again, if they do come out and basically everyone did agree on it, then there'll be no reaction from that specific release. So it's all we're listening for is wording when we come to the FOMC in 3 weeks' time. You also have US interest rates futures put charts of a Fed rate hike at the next meeting, so in September at 18% and 36% in November after the statement. Because again, the statement, okay, that's fine. Fed to consider extent of additional firming to curb inflation. So yeah, they're really the key things that have been said so far. Again, we basically faded that move. This isn't a surprise. We saw this exact same thing on the last meeting. You'll basically just see this most likely stay now within this range until we have the conference again in about 22 minutes from now. Again, that's released at 2:30. And that's when Jerome Powell will actually be speaking. And so again, obviously we will be watching that live, grabbing the key things. And again, the main thing on these meetings is just listening for if there's anything said differently. That's always going to be that key thing we're listening to. Again, I'm still watching the calls and the puts. I'm looking at the $4,555 strikes on the puts. Looks like it's going to be the more reasonable entry or more likely entry. Again, looking at a $650 entry on either one. First time we hit. Again, that's when I'll be looking to get into that trade.
Memories keep me frozen, looking past in the moments. None of them seem to
some research with yield curve, and I say it's very, very inverted right now. Do we have to then restore and rebuild term premia in that, and do those back end rates have to come up and we disinvert or start to steepen the curve? So I'm not sure that the back end of the market might be hearing the soft landing scenario. The back end of the market still seems priced more for a harder landing, and I think there's some disconnect there in the markets.
Steve Leisman, let's go back to you. We are not too long away from the Fed's press conference at this point. What's your number one question?
Well, before I get there, Melissa, I want to make a comment about the idea that a quarter point doesn't matter. I think people need to be aware of the kind of fine-tune engineering that Powell's trying to do here. If you go back and look at what's happened to the 2 year.
We've got the conference up and ready. So again, I'll put that on screen as soon as we turn live, and that's when we'll get rid of the CNBC news. Again, the last kind of few meetings, they have been a few minutes late, but from the 1/2 we'll throw it on the screen.
Trying to kind
So
of
just as an early heads up, in under 20 minutes time now, to get the FOMC press conference following the rate decision there with Chair Powell. The live video is available on the feed now for anyone interested.
That would be stimulative to the economy. So that's why those other 25s or the additional 25s and the possibilities, that's why it matters. I think it's a bit like a balloon. You get up there and you put the burner off a little bit, you maintain your altitude level. That's what he's trying to do. He's not had as much success in the stock market, which may indeed, Melissa, be one of my questions, is how much concern the chairman has about the loosening of financial conditions as evidenced in the run of the stock market. But at least when it comes to the area that he directly or more directly controls, which is the short end of the yield curve, what I think he's trying to do is to keep those yields high while backing off and not letting the market begin to price those rate cuts in. That would really create stimulus from the stock market as well as from the bond market.
I mean, since the June meeting, the 2-year yield has gone up 40 basis points and the S&P 500 has gone up 5 percentage points. Stephanie Link, how do you think that factors into the...
Again, I'm just writing down the key parts from that meeting. I'll throw it in a Word document, and again, just the key wording that we want to be paying attention to then for the meeting minutes and also the conference.
Rate has been to the upside for much of this year. People didn't want to believe that things were going to be a soft landing, that we're going to have a soft landing, and yet now everybody's coming around to that thought. So how does that set us up for the back half, given the possibility that the Fed could be on the sideline for the rest of the year?
Well, we'll see if they're going to be on the sidelines, but they're definitely at the latter stages in terms of hiking rates. That being said, they're not going to ease anytime soon, Melissa. They didn't just work this hard for the last year just to turn around and pivot. So we're not talking about that between now and the end of the year. And the reason the market is going up is because earnings have stayed pretty good. Not great, but pretty good. They haven't collapsed. And that was the call from many people that earnings would collapse. And that's because there's so much underlying momentum in the economy from all of the stimulus that was put into the economy. And we just had the infrastructure bill go through. So that's kind of offsetting what the Fed is doing to some degree. I think in the press conference, I'm going to be interested to hear what he says about where we are with financial conditions, because that'll be interesting to see how he answers that. But overall, I think the statement was exactly in line. The economy is doing fine at 2.4% in GDP. Jobs are strong, wages still and inflation still remain too elevated. And so we'll have to see what they say. But I think they stated the obvious in the press release.
Rick Santelli, we've gone around the horn. Why don't we come back to you if you're still there with some reaction? You still have an inverted yield curve. You still have some concerns out there about a slowing economy. Wrap it up for us.
Well, I think we are not up 40 basis points, by the way, since the June meeting. We're up half that. We're up 20. They're basically at 469. We're at 489. I think if I had to wrap this up, the inverted yield curve is sticky, and I do exactly agree that we need to steepen it, de-invert it. But my feeling is the de-inversion is going to mostly be by short rates moving lower. Consider this. Yes, we moved 20 basis points roughly in two since last meeting, about 10 basis points in tens. But the stock market has zoomed rather aggressively since then. And if you look at just how much the stock market has moved, really, since the June meeting, and compare that to money market rates, it certainly looks as though you have a tough choice to remain on the money market side. Having said that, there is a risk, of course, that stocks may start to move a bit lower. But all things considered, I think that the Fed models and the relationship with the labor market are most likely a bit distorted, and I will continue to say that the first half of this year looks significantly different than the last half of last year by all the important metrics of the Fed, from the labor markets to inflation.
What would your question to the Fed be, Bob?
Well, I asked the same question on the stock market. You brought up a great point, Melissa. You're a good market watcher. The pain trade all year has been market goes higher because people have bet against the soft landing. Now this is all starting to change. The pain trade is for the market to drop, rates to go up. So I think that the logical question here is, what issues does he see that concerns him right now? And he's got to say the stock market in some way, because to them, that's a wealth indicator. And that, of course, pushes up perceptions that everything is okay, and does not help the idea of a slowing economy. He does want a soft landing. He said that, but he said he is willing to go through some pain to make sure that inflation gets down to that 2% target. I can't help but think that a record streak on the Dow, S&P at new highs, 20 times forward earning valuations in expansion range for the economy helps the idea that the market's going to slow down. So I would agree that the question is about the stock market.
All right, Stephanie, gentlemen, thank you very much for a very informative panel. We appreciate your time today. Coming up, we are waiting to hear from the Fed chairman himself about the rate decision. We'll talk to former Fed Vice Chair Richard Clarida about what to expect. And a quick programming note as we head to break. We have a huge list of executives on Power Lunch over the next 2 days. Tomorrow, we'll speak to the CEOs of Crocs.
Suffer among the silence, vulnerable to the violence, deafening voice of silence, splinters in my heart. Memories keep me frozen, looking past in the moments. None of them seem to notice.
Just put it in the comments as well, the key parts from this meeting, just so you can read it at your own pace.
Silence, vulnerable to the violence, deafening voice of silence, splinters in my heart.
Also just updated the rolling news at the bottom of the feed. Again, that will now be FOMC related.
Interest rates now at the highest level in some 22 years. Let's get some reaction perspective from Richard Clarida, former Fed Vice Chairman and Global Economic Advisor at PIMCO. Richard, welcome. It's good to have you with us as always. I think in the statement, the key word here is, or phrase maybe, is that the chair and the committee refer to the extent of policy firming that may be indicated.
Also, just seeing from the White House, they have seen reports of second Russia aircraft flying dangerously close to US drones.
Statement, and I think at the time was viewed maybe a touch dovish, and then of course in the June meeting we had the skip, but we had the more hawkish elevation of the dots. No dots today, but I think when you look at statements, there is a decision to leave wording unchanged, and I think
also saying about Sam Bankman-Fried, U.S. prosecutors are seeking to have the founder detained.
A few moments ago, referred to the idea that the Fed was sort of behind the curve. Do you agree with that, or not, or have they gotten out from that?
The Fed is not behind the curve. They have moved rates.
In 10 minutes time now, the bottom of the hour, you can get the FOMC press conference with Chair Powell. The video to watch along live is on the feed.
They've pushed back on the idea that they're on the verge of cutting. I think the Fed is close to where they're going to need to be to put inflation on a path down towards 2%. But again, the chair, I think, will leave his options open to go at the September meeting, to skip the September meeting, to go later in the year.
In the statement, Rich, the Fed repeated that tighter credit is likely to weigh on activity. We haven't seen too much of that between the last meeting and today. And I'm wondering, in terms of the long and variable lag effects, what you think the number one concern, the number one effect is in your mind. Is it tighter credit? And is that mainly from the banking crisis, or is it from the rate hikes?
I think it's a combination. I think tighter credit, historically, there is a lag. You are actually seeing data that the number of loan applications being turned down has moved up. Loan growth is basically stalled. I would expect some of the additional regulatory measures that the Fed's going to put in place after SVB are going to tighten.
Those puts are pulling back a bit more now. Again, still not quite near that entry. Probably going to have to wait for the conference for an entry on those.
Showing it. So these things do take time, but I do think we will start to see additional slowdown in the economy from these conditions.
Knowing that the Fed is in the FDIC will meet on Thursday to vote for an initial round on the new bank regulations, Rich, do you think that is in mind when the Fed is going to, when Jerome Powell takes that podium and talks to reporters and talks to the world about what their intentions are, will that factor in, knowing that there are those new capital requirements to come, and that will be an additional tightening on credit?
Yeah. Here I would distinguish between two related but distinct measures. Mm-hmm. There's the so-called Basel III measures that they will be talking about, and those would be phased in and there would be a comment period. I think more front and center this calendar year will be after the SVB and related disruption in the spring. We heard commentary from Vice Chair Barr and other Fed officials that they're going to take a second look, an additional look at capital and liquidity standards for banks in that 100 billion plus category, and they can do that without, an extensive comment period as they will with Basel III. They can do that under existing statutory authority, and we would expect that to happen as well.
Where would you expect inflation, and specifically core inflation, to be, let's say, a year from now?
Well, here, I think I'm going to say both what I expect and what I hope. I do think a year from now that the Fed's preferred measure, core PCE inflation, will be in the 2s. I think there's uncertainty about, the path there. We here at PIMCO are really optimistic that we're going to start seeing some real improvements in the inflation data because, in particular, housing and rental inflation has slowed down. And I think there is good reason to believe that we will have core inflation, in July of next year, somewhere in the 2s, probably north of 2.5, I would imagine, somewhere between 2.5 and 3. And of course, the Fed, in its June projections, did have core inflation falling to 2.6% by the end of next year. So I think that's in line with their assessment as well.
Rich, you've been inside the room. Does it irk the Fed, do you think, that the stock market has been rallying all year and is up 5% since the June meeting alone?
I don't know if I'd use the word irk. I think the chair has been asked, and perhaps even by Steve Leisman at recent press conferences, and I think his answer is, look, the market may be assessing a different probability than the Fed does of economic slowdown and the like. And so within range, look, I think they correctly, certainly when I was there, we really focused on broader financial conditions, lending standards, how much does it take to take out a car loan, and the like. And those have clearly tightened. So I don't think they're going to get too caught up in the stock market here.
All right. Rich, thank you.
Thank you.
Rich Clarida. We are just minutes away from Fed Chair Jay Powell's press conference. We'll take you there live as soon as it begins. But first, final thoughts from JP Morgan's David Kelly. That's next.
Okay, now we have about 5 minutes, or dead on 5 minutes, until this release. Starting to see basically, well, again, the stocks are basically faded, bonds near the lows.
So we're now 5 minutes away from the bottom of the hour, where we do get the FOMC press conference with Chair Powell, link to which is available on the feed.
Yeah, bonds are basically at the lows, or the euro selling off, not quite faded the original move. VIX near the lows, and we're seeing the S&P break back down, basically fade all of its move, give back most of its gains. Again, still looking for the trading opportunities on the calls or puts of the SPX. I'm still looking at the strikes of 4,555. Basically just waiting for one of the two to sell off 50%, and then that's usually near enough where I get my entry. Still seeing weakness on Google, Microsoft coming into this release. However, we are seeing a bit more strength on the Snap side, starting to pick up and basically hold that $10 support, as well as basically that deviational level. So that's looking good. Again,
US Senate Majority Leader Schumer says he is worried about House Republicans heading to government shutdown.
Also, the conference has still not started.
This stream is sponsored by To The Tick. Get free daily pivot points, Fibonacci, and market profile levels by signing up at tothetick.com.
We will, I guess, throw this on the screen now, getting ready for it. So we will disable the CNBC news because we won't need that anymore. And I will try and... I don't really know how big I can make this. I guess I can cover that. We don't need the SPX chart because we have that. I don't know why this is so hard to get in place. Because we have the S&P and the ES chart already on the screen anyway. So again, we'll have it like that. Do that. And then we should be able to see everything as it's coming out. SPY and the S&P did break its faded level, so meaning the at the open at 2. Did get bought into quite quickly though, But again, we'll start seeing how this reacts. Main thing is just going to be on the conference. Again, we have about 2.5 minutes now until this release. So I guess we'll start seeing how that goes. I'll just play some of this while we're waiting. Again, we still have about 2 minutes till the stream starts.
Memories keep me frozen, looking past in the moments. None of them seem to notice. Splinters in my heart, suffer among the silence, vulnerable to the violence, deafening voice of silence, splinters in my heart.
So we're shortly expecting the FOMC press conference with Chair Powell to begin, and the live video is available on the feed.
Again, we do have the conference officer here. As soon as it actually goes live, we will be able to see it. That hasn't quite gone live yet. Make sure I've got audio on. I do not. Okay, actually, I'll put that max. And I'll just mute it until we actually cease from speaking. Should be interesting. Don't really have anything key that we're listening for as of right now. Again, it will just be if it says, I'll point it out if anything diverges from basically what's said before. Okay, here we go. It looks like we're launching. Recently as well, we have been seeing it take him about 40 seconds to come out to the actual table. So again, we can see how long or how delayed he is. Obviously, we got the clock at the bottom left, so you'll be able to see dead on how late he is. Just making sure everything's live. Just got no sound from that. It's quite weird. I'll double check. Okay, there we go. He's coming out.
Good afternoon.
So Powell says FOMC squarely focused on the dual mandates.
Squarely focused on our dual
In commodities, quickly just seeing the NYMEX natural gas August futures settling at $2.
We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. Today, we took another step by raising our policy interest rate a 1/4 percentage point, and we are continuing to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Looking ahead, we will continue to take a data-dependent approach in determining the extent of additional policy firming that may be appropriate. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a moderate pace. Growth in consumer spending appears to have slowed from earlier in the year. Although activity in the housing sector has picked up somewhat, it remains well below levels of a year ago, largely reflecting higher mortgage rates. And higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the past 3 months, job gains averaged 244,000 jobs per month, a pace below that seen earlier in the year, but still a strong pace. The unemployment rate remains low at 3.6%. There are some continuing signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has narrowed, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in May, total PCE prices rose 3.8%.
Nothing divergent from the
Excluding volatile food and
statement
energy
as of now.
categories, core PCE prices rose 4.6%. In June, the 12-month change in the Consumer Price Index, or CPI, came in at 3.0%, and the change in the core CPI was 4.8%. Inflation has moderated somewhat since the middle of last year. Nonetheless, the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher cost of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning to inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 5.25% to 5.5%. We are also continuing the process of significantly reducing our securities holdings.
Just put some lines on the spine. The ES.
With today's action,
These are just
we've
where we
raised
opened
our
at
policy
2:30.
rate by 5.25 percentage points since early last year. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of our ongoing monetary restraint to be realized, especially on inflation.
Not an ideal time for it to be lagging.
In addition, the economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. In determining monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will continue to make our decisions meeting by meeting, based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance.
There we go, finally a strong
risks.
move in the SPY. The puts are at a potential long. I'm just going to turn
committed to bringing inflation back to our 2% goal and to keeping longer-term inflation expectations well anchored.
I've got no clue what's happening. I'm hoping this is not my
Reducing
Wi-Fi.
inflation is likely to require a period of below-trend growth and some softening.
Oh my God.
Of labor market conditions. Restoring price stability is essential.
I got nothing to close.
Essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that
let's reload it. So
policy firmament may be appropriate. Should we take that to mean that additional hikes are likely on the way? And should we also believe that all future meetings, say September and November, are live, or are you in a every other meeting mode? Thank you.
So we haven't made a decision to go to every.
Oh my.
every other meeting. It's not something we've looked at. We're
I'm
going
gonna
to
try
be
and
going meeting by
hotspot,
meeting,
see if it's
and,
my
As
issue.
we go into each meeting, we're going to be asking ourselves the same question. So we haven't made any decisions about any future meetings, including the pace at which we'd consider hiking. But we're going to be assessing the need for further tightening that may be appropriate. You read the language, to return inflation to 2% over time. I would say that the intermeeting data came in broadly in line with expectations. Economic activity remained resilient. Job creation remained strong while cooling a bit. And the June CPI report actually came in a bit better than expectations for a change. And the June CPI report, of course, was welcome, but it's only one report, 1 month's data. We hope that inflation will follow a lower path but it will be consistent with the CPI reading. But we don't know that, and we're just going to need to see more data. So what are we going to be looking at? Really, it will be the whole broader picture. And starting with, we're looking for moderate growth, right? We're looking for supply and demand through the economy coming into better balance, including in particular in the labor market. We'll be looking at inflation. We'll be asking ourselves, does this whole collection of data, do we assess it as suggesting that we need to raise rates further? And if we make that conclusion, then we will go ahead and raise rates. So that's how we're thinking about the next meeting, and how we're thinking about meetings going forward potentially. But we're now mainly thinking about the next meeting. I will also say, since we're talking about it, between now and the September meeting, we get 2 more job reports, 2 more CPI reports. I think we have an ECI report coming later this week, which is Employment Compensation Index. And lots of data on economic activity. All of that information is going to inform our decision as we go into that meeting. I would say it is certainly possible that we would raise funds again at the September meeting if the data warranted. And I would also say it's possible that we would choose to hold steady at that meeting. We're going to be making careful assessments, as I
I've
said,
just brought
meeting
up
by
some puts.
And I'll close by saying we've raised the federal funds rate now by 525 basis points since March 2022. Monetary policy, we believe, is restrictive and is putting downward pressure on economic activity and inflation.
If I could just briefly follow up on something you said there. You said the data in the intermediate period, it broadly came in line with expectations. Does that mean there's unlikely to have been a change in the overwhelming outlook of the committee that 2 more hikes are necessary?
I'm just going to go back to what I said. That's the question. We have 8 weeks now until the September meeting, and all that data that I recited, we're going to be looking at all of that and making that assessment then. And it really, we did have the one good reading, and of course we welcome that, but it's just one reading, as everybody knows. And we've seen this before in the data. Many forecasts call for rates for inflation to remain low, but we just don't know that until we see the data. So we'll be focusing on that.
Gina. Thank you. Thanks for taking our questions, Chair Powell. Obviously, you upgraded the language around growth in the statement today. We've seen the Barbie movie numbers. We've seen everyone going to Taylor Swift concerts this summer. It seems like the American consumer is in pretty good shape. And it does seem like growth is sort of picking back up a little bit, or at least doing well. And I wonder, from your perspective, if that continues, if we see growth not just stabilizing, but performing well this summer, is that a problem because it's inflationary, or is it good news because it suggests that a soft landing is more likely? Just how are you thinking about that sort of trajectory?
Yeah, so I would say it this way. The overall resilience of the economy, the fact that we've been able to achieve disinflation so far without any meaningful negative impact
Also, just
on the
like
labor
super
market,
strength in the
economy,
euro, meaning the
overall,
dollar is super weak.
That's a good thing. It's
Supplies
good to
also
see that,
fishing
of
those
course.
highs. Again, we
It's
are
also,
in the
you see
puts.
consumer
Just hold them
confidence
really.
coming up and things like that.
No
That will
crazy
support
amount of money in there,
activity
so
going forward.
if it expire
But
worthless,
you're
it
right,
expire
though. At the
worthless.
margin, stronger growth could lead over time to higher inflation, and that would require an appropriate response from monetary policy. So we'll be watching that carefully and seeing how it evolves over time.
Neil.
Thanks, Chair Powell. Neil Irwin from Axios. So as you referenced earlier, in the intermeeting period, soft CPI, jobs reports, still strong but moderating, JOLTS look good. So if you're data dependent, why not pause again? Why not stay on hold? Why not take another meeting off when the data was at least cutting in the direction you want to see?
So if you go back to what we're trying to do here, we're trying to achieve a stance of policy that's sufficiently restrictive to bring inflation down to 2%. At the last meeting, we wrote down our individual estimates of what that would take, and the median of that was an additional 2 rate hikes. So I would say we looked at the intermeeting data, and as I mentioned, broadly consistent, not perfectly consistent, but broadly consistent with expectations, and as a result, we went ahead and took another step. And that's, a labor market that continues to be strong, but gradually slowing. I mentioned that the inflation report was actually a little better than expected, but we're going to be careful about taking too much signal from a single reading. And growth came in stronger than expected. So that's how we look at it, and so we did take that step today.
Nick Timmeros of the Wall Street Journal. Chair Powell, markets widely believe the median FOMC participants' inflation forecast from June for the fourth quarter of this year will be too high, given autos and shelter, and that by September that may warrant a downward revision in the inflation forecast of 20 to 30 basis points. Would that type of inflation progress be enough to hold rates steady from here, or do you need to see below-trend growth and decelerating labor income growth to be convinced that you've done enough?
So it's hard to pick the pieces apart and say, how much of this and how much of that. We'll be looking at everything. And, of course, we'll be looking to see whether the signal from June CPI is
Now we just see if this is a temporary pullback or a full-on pullback.
Or whether it's somewhere in the middle. We'll be looking at the growth data. We'll be looking at the labor market data very closely, of course, and making an overall judgment about that. It's the totality of the data, I think, but with a particular focus on making progress on inflation.
If I could follow up, last month you said there were benefits to moderating the pace of increases because it would give you more information to make decisions. Would another CPI report like the one we just had in June allow you to at least maintain that slower pace and defer until the fall any decision on whether you need that second rate hike?
So I'm just going to tell you again what we're going to do in September. We're going to look at 2 additional job reports, 2 additional CPI reports, lots of activity data. And that's what we're going to look at, and we're going to make that decision then. And that decision could mean another hike in September, or it could mean that we decide to maintain at that level. And again, the question we're going to be asking ourselves is the overall signal one that we need to do more, that we need to tighten further? And if we get that signal whenever we get it, then, and that's the collective judgment of the committee, then we will move ahead. If we don't, then we'll have the option of maintaining policy at that level. But it's really dependent so much on the data, and we just don't have it yet.
Chris.
Hi, Chris Rugaber at Associated Press. So consumer confidence in the economy is rising, likely in large part because of the declines in headline inflation. You also see wages are also rising faster than prices now after trailing them for a long time. How much are Americans truly harmed by inflation at its current level, headline level of 3%? And with that in mind, when do you put some weight back on the employment side of the dual mandate?
So I guess I'd say it this way. First, it is a good thing that headline inflation has come down so much, because that's really what the public experiences. And I would say that having headline inflation move down that much almost creates it will strengthen the broad sense that the public has that inflation is coming down, which will in turn, we hope, help inflation continue to move down. So you are really, sorry, what your question was?
Well, I mean, you've talked for many press conferences now about the harm created by inflation, how hard it is for people. So how much of that are we still seeing with inflation now down at 3?
So I guess I would put it this way. I'd say it this way. It's really a question of how do you balance the 2 risks, the risk of doing too much or doing too little. And, I would say that, we're coming to a place where there really are risks on both sides. It's hard to say exactly whether they're in balance or not, but as our stances become more restrictive and inflation moderates, we do increasingly face that risk. But, we need to see that inflation is durably down that far. As you know, we think, and most economists think, that core inflation is actually a better signal of where headline inflation is going, because headline inflation is affected greatly by volatile energy and food prices. So we would want core inflation to be coming down, because that's what we think core is signaling where headline is going to go in the future. And core inflation is still pretty elevated. There's reason to think it can come down now, but it's still quite elevated. And so we think we need to stay on task, and we think we're going to need to hold certainly hold policy at a restricted levels for some time, and we need to be prepared to raise further if we think that's appropriate.
Well, and then if inflation were to, just a quick follow, if it stays at 3 or drops even a little bit more, I mean, how much of an increase in unemployment do you think is acceptable to get that last bit of inflation? People are talking about the potential difficulty of the so-called last mile of inflation. So, but how much unemployment do you think is justified to get down that last?
So it is a very positive thing that actually the unemployment rate is the same as it was when we lifted off in March of 22 at 3.6%. So that's a real blessing, and that we've been able to achieve some disinflation. And we don't seek to, it's not that we're aiming to raise unemployment, but I would just say the historical record, we have to be honest about the historical record, which does suggest that when central banks go in and slow the economy to bring down inflation, the result tends to be some softening in labor market conditions. And so that is still the likely outcome here. And we hope that that's as little as possible. We have to be honest that is the likely outcome. The worst outcome for everyone, of course, would be not to deal with inflation now, not get it done. Whatever the short-term social costs of getting inflation under control, the longer-term social costs of failing to do so are greater, and that the historical record is very, very clear on that. If you go through a period where inflation expectations are not anchored, inflation is volatile, it interferes with people's lives and with economic activity, and that's the thing we really need to avoid and will avoid.
Michael McKee. At this point, you say the policy is restrictive, but all year long we have seen growth surprise to the upside, unemployment to the downside, and inflation lately to the downside. So I'm wondering, by definition, should you be restrictive enough right now under these conditions? Do you think you might need to do more? Because I'm curious about what you see as inflation dynamics now. Is the economy still moving in a direction where it creates more inflation? People talk about base effects and higher energy costs, and now we have some large labor settlements. Or is the economy disinflating, and you're able to go back to the old Fed policy of opportunistic disinflation?
So I'll just say, again, the broader picture of what we want to see is we want to see easing of supply constraints and normalization of pandemic-related distortions to demand and supply. We want to see economic growth running at moderate or modest levels to help ease inflationary pressures. We want to see continued restoration of supply and demand balance, particularly in the labor market, and all of that should lead to declining inflationary pressures. Now, what we see is those pieces of the puzzle coming together, and we're seeing evidence of those things now. But I would say that what our eyes are telling us is that policy has not been restrictive enough for long enough to have its full desired effects. So we intend, again, to keep policy restrictive until we're confident that inflation is coming down sustainably toward our 2% target, and we're prepared to further tighten if that is appropriate. And we think the process, still probably has a long way to go.
Well, do you think under current conditions you are restrictive enough unless something changes?
Well, I think we think today's rate hike was appropriate, and I think we're going to be looking at the incoming data to inform our decision at the next meeting about is the incoming data telling us that we need to do more, and if it does tell us that collectively, if that's our view, then we will do more.
Colby.
Thank you. Colby Smith with the Financial Times. If September is in fact a live meeting, how does that square with the need for a more gradual tightening pace that you spoke of last month in explaining the rationale for holding the funds rate steady at the June meeting?
So a more gradual pace doesn't go immediately to every other meeting. It could be 2 out of 3 meetings, right? It just means if you're slowing down. The point really was to slow down the decision cycle as we get closer and closer to, we think, our destination. And I wouldn't want to go automatically to every other meeting because I just don't think I think it's not an environment where we want to provide a lot of forward guidance. There's a lot of uncertainty out there. We just want to keep moving at what we think is the right pace. And I do think it makes all the sense in the world to slow down as we now make these finally judged decisions And so that's what we did. And so I think it's possible, I mentioned before, it's possible that we would move at consecutive meetings. We're not taking that off the table, or we might not. It's really going to depend on what the data tell us. That's the best we can do.
So we shouldn't assume that every other meeting is the lowest tightening frequency, let's say. It could be, longer intervals in between as well.
I think we're going to, look, I think we're going to make a decision about the next meeting, and then we're going to make a decision about the one after that, and I think it'll sort itself out.
Thanks. Howard Schneider with Reuters. Among your colleagues, there have been people who've said they feel that very little transmission has taken place so far from monetary policy into the economy, and there are those who feel, they say, it's happened very fast this time and it's kind of up to date. Where are you on that continuum?
So there's a long-running debate about the lags between changes in financial conditions and the response to those changes from economic activity and inflation, right? So we know that in the modern era, financial conditions move in anticipation of our decisions, and that has clearly been the case in this cycle. So in a sense, the clock starts earlier than it used to, but that doesn't necessarily change the process from that point on, and it's not clear that it has. We also, I'll tell you what we know and then what we don't know. We know that financial conditions affect economic activity and inflation with a lag that can be long and variable, or lags, plural, that can be long and variable. A lot of uncertainty around the length of the lags, and by the way, that's just one component of the broader uncertainty that we face. So I'll tell you how I think about this. The first thing to say is we're determined to bring inflation down to 2% over time, and we will use our tools to do that. No one should doubt that. I would look at it this way, though. The real federal funds rate is now in meaningfully positive territory. If you take the nominal federal funds rate, subtract a mainstream estimate of near-term inflation expectations, you get a real federal funds rate that is well above most estimates of the longer-term neutral rate. So I would say monetary policy is restrictive, more so after today's decision, meaning that it is putting downward pressure on economic activity and inflation. We'll keep monetary policy restrictive until we think it's not appropriate to do so. So that's how I think about it. I mean, if I sum it up, I would say we've come a long way. We are resolutely committed to returning inflation to our 2% goal over time. Inflation has proved, repeatedly, has proved stronger than we and other forecasters have expected. And at some point that may change. We have to be ready to follow the data, and given how far we've come, we can afford to be a little patient as well as resolute as we let this unfold.
On the credit side, I'm wondering if you saw anything in the latest SLOOS data that made you think you're getting a quantum of credit contraction beyond what you'd expect. The bank lending data really is, the growth rates edging down towards and below, heading below zero, which is usually a recession indicator.
So I guess the SLOOS will come out early next week, and I would just say it's broadly consistent with what you would expect. You've got lending conditions tight and getting a little tighter. You've got weak demand, and it gives a picture of pretty tight credit conditions in the economy. I think it's really hard to tease out how much of that is from this source or that source, but I think what matters is the overall picture is of tight and tightening lending conditions, and that's what this SLOOS will say.
Rachel. Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. Could you break down the reasons why inflation has fallen and what share of that credit you would give to factors that don't stem directly from rate hikes or that might be within your control at all, like easing supply chains and a drop in energy prices over the past year?
Yeah. So, interesting question. So, let me start by saying that the inflation surge that we saw in the pandemic resulted from a collision of elevated demand and constrained supply, both of which followed from the unprecedented features of the pandemic and the response from fiscal and monetary policy. And we've always expected that the disinflationary process would stem from both from the normalization of those broad pandemic-related supply and demand conditions and from restrictive monetary policy, which would help return the balance between supply and demand by restraining demand. And we think that's broadly what we're seeing. So to go break it down a little further, of course, headline inflation has come down sharply from elevated levels as energy and food prices have come down, mostly due to reversal of the effects from the war in Ukraine. And that's a good thing, and the public experiences that, as I mentioned earlier. For core inflation, I'd say there has been a role for both factors, both that I mentioned. Clearly, for goods, normalization of supply conditions is playing an important role, as is the beginning of the reversal of spending back into services and away from goods. Take autos as an example. The combination of an increase in sales and inventories, while vehicle inflation has decelerated, points to a substantial role for supply. But there's also a role for demand, as the loans and things like that are more expensive. So they're both working there. Housing services inflation now starts to move down. Clearly, higher rates have slowed the housing market. I would say monetary policy is working about as we expect, and we think it'll play an important role going forward, in particular in non-housing services, where really we think that's where the labor market will come in as a very, very important factor. So we think both of those sources of disinflation are playing an important role.
I see. And just to follow up, do you think that of those two sources, that core will rely more heavily on seeing an impact from rate hikes, or is there a more even split there too?
I think monetary policy is going to be important going forward, because we're sort of reaping now the benefits of the reversal of some of the very specific pandemic things. We're seeing that with goods in particular, with supply chains and shortages moving, and we're seeing. So I think going forward, monetary policy will be important, particularly in the sector, in the non-housing services sector.
Edward. Thank you, Chair Powell. First, let me compliment your tie, the choice of tie. So thanks for taking our question. So the Beige Book, it said, input cost pressures remain elevated for services firms, but eased notably for manufacturing sector. Is that an indication that there's a wage inflation pressure? And how do you target and pressure on the wage inflation without pushing the economy into recession?
Well, I think as it relates to goods, it's really an indication that supply chains and shortages are easing. And so what was the first part of it?
So wage inflation, like how do you target wage inflation without pushing an economy into a recession?
I don't think we're targeting wage inflation. I think what we're looking for is a broad cooling in labor market conditions, and that's what we're seeing. So wages have actually been gradually moving down. They're still at levels that would be consistent over a long period of time with 2% inflation. Nonetheless, we're making progress there. And by so many indicators, labor market demand is cooling. You can look at surveys by workers and businesses who see that. You can look at the quits rate normalizing. You can look at job openings coming down. You can look at just job creation in the establishment survey has, it's still at a high level, but it was at really an extraordinarily high level for most of the last 2 years. So you see cooling, particularly in private sector in the last in the last report. So I think we see that, and it's happening at a gradual pace. So that's actually not a bad thing in a sense, because if what we see is a labor market, very strong demand for labor, which is really the engine of the economy. People are getting hired, many people going back to work, getting wages, spending money, and that's really what's driving the economy. But that it's gradually slowing, it's gradually cooling. That's a good prescription for getting where we want to get.
But still, we see a push to raise minimum wage. We're seeing a lot of unions go on strike or threaten strike, and the common thing is they come out with agreements like big pay increases, like UPS, and we have the auto workers coming up. Are you concerned then about a trend of series of big unions, these contract pushing wage inflation then?
Not for us to comment on contract negotiations. Not our job, not our role. We monitor these things, and we'll keep an eye on them. But really, that's something that's handled at that level. And not,
Victoria. Hi, Victoria Guido with Politico. I wanted to ask about the SEP, which suggests that you would cut rates as overall and core PCE get to around or under 3%. And so I'm wondering, is the level of inflation what's sort of important there as you think about getting to 2% and when you might start cutting rates, or is the speed at which inflation is falling also important?
I think you'd take both into account. I think you'd take everything into account when you start cutting rates. It would depend on the whole, on a wide range of things. And when people are writing down rate cuts next year, it just is a sense that inflation is coming down and we're comfortable that it's coming down and it's time to start cutting rates. I think But I mean, there's a lot of uncertainty between what happens, you know, in the next meeting cycle, let alone the next year, let alone the year after that. So it's hard to say exactly what happens there, what's motivating people.
So if it's sort of stubbornly in maybe the high twos, you wouldn't necessarily cut rates.
I'm not saying that at all. I'm not giving you any numerical guidance around that. I'm saying we'd be comfortable cutting rates when we're comfortable cutting rates, and that won't be this year, I don't think. It would be, you know, many people wrote down rate cuts for next year. I think the median was several for next year, and that's just going to be a judgment that we have to make then, a full year from now, and it'll be about how confident we are that inflation is in fact coming down to our 2% goal.
A good part of Wall Street has become more confident that the Fed is going to be able to engineer a soft landing, and they've reduced their forecast for recession. And I'm wondering if the staff has changed its view on the likelihood of a recession being likely, and if you personally have changed your view in terms of becoming more confident that you can achieve a soft landing.
So it has been my view consistently that we do have a shot, and my base case is that we will be able to achieve inflation moving back down to our target without the kind of really significant downturn that results in high levels of job losses that we've seen in some past instances, many past instances of tightening that look like ours. That's been my view. That's still my view. And I think, you know, that's sort of consistent with what I see today. So, but it's a long way from assured, and you know, we have a lot left to go to see that happen. So the staff now has a noticeable slowdown in growth starting later this year in the forecast. But given the resilience of the economy recently, they are no longer forecasting a recession. I just want to note that that our staff produces its own forecast, which is independent of the forecast that we, as FOMC participants, produce. Having an independent staff forecast, as well as the individual participant forecast, is really a strength of our process. There's just a lot of, I think, constructive diversity of opinion that helps us make, informs our deliberations, helps us make, I hope, better decisions.
And is the reason for optimism that inflation has come down and you still have a strong labor market? I mean, does that add to the optimism?
I wouldn't use the term optimism about this yet. I would say, though, that there's a pathway. And yes, that's a good way to think about it. We've seen so far the beginnings of disinflation without any real costs in the labor market, and that's a really good thing. I would just also say the historical record suggests that there's very likely to be some softening in labor market conditions, and consistent with having a soft landing, you would have some softening in labor market conditions, and that's still likely as we go forward with this process. But it's a good thing to date that we haven't really seen that. We've seen softening through not through unemployment, not through higher unemployment. We've seen softening through you know, job openings coming down part of the way back to more normal levels. The quits rate, so people are not quitting as much. We've seen participation, people coming in, and so labor supply has improved, which has lowered the temperature in the labor market, which was quite overheated, you know, going back a year or so. So we're seeing that kind of cooling, and that's very healthy, and you know, we hope it continues.
Jeff.
Thank you, Mr. Chairman. Jeff Cox from CNBC.com. You and other Fed officials
Okay,
in
we
the past
have
had suggested that you don't need
we
to
have the
keep
SPY and the ES
hiking
coming into the
until
anchor
inflation
VWAP. Our
hits
puts basically
2%,
actually break
that,
even as of right now.
as long as you see continued progress. So I'm wondering,
But we'll see if
how
we can
close
break.
do you need to get with the inflation numbers coming down? How many months of data do you need to see that will give you sufficient confidence? And you know, how far does this fight need to go before you're willing to kind of declare victory on it?
So the idea that we would keep hiking until inflation gets to 2%, it would be a prescription of going way past the target. That's clearly not the appropriate way.
And there we go, a bit of a crack. We're up over 10% now.
If you look at our forecasts, the median participant, and again, these are forecasting out years, so take them with a grain of salt, but people are cutting rates next year because the federal funds rate is at a restricted.
There we go. Just jumped out of those, by the way. They're up 20%, so just felt like getting out now because they took a while to come in the money, so the time decay could actually get dangerous because, again, they're 0 day to expiration, so out completely now. Going to carry on watching, but no more trades.
We of course would be very careful about that. We'd really want to be sure that inflation is coming down in a sustainable level. And it's hard to make. I'm not going to try to make a numerical assessment of when and where that would be, but that's the way I would think about it. Is you'd stop raising long before you got to 2% inflation, and you'd start cutting before you got to 2% inflation too, because we don't see ourselves getting to 2% inflation until all the way back to 2 until.
Seems like we're getting the complete fade. If we did stay in now, they would have been up 50%, but again, it just took time. I didn't feel as comfortable staying in, but yeah, they're up. Oh, now they're up 100%. Really should have stayed in then. Yeah, they're up 100% now. Crazy moves over that, nearly 200%. Absolutely flying those. I'll show you what I'm looking at.
Bank of California's acquisition of PacWest. Does this acquisition suggest the full impact has not?
This is what I was looking at. Again, that same strategy. They come down, look to buy, and now they're absolutely flying through. We can see they would have already been up 150% if we were able to hold. Again, I ended up actually getting out around here just because it took so long to get there, but in this case would have been a much more sensible trade to hold. But again, we never know that. It's easy to see in hindsight. He hasn't said anything too recently as well that's super bearish, so I don't know why now we're moving all of a sudden.
We're still watching, the situation carefully and monitoring, conditions in the banking sector. In terms of the actual effect on, if you think of a particular set of banks that were affected because of their size and business model and things like that, that were more affected by the turmoil in March than others, it's very hard, as I mentioned, it's very hard to sort of tease out the effects on this very large economy of ours from them tightening. They may be tightening a little bit more, probably are, than other banks. The SLOOS has been telling us for more than a year that banking conditions are tightening. That process is ongoing, and that will restrain economic growth. So I think we have to take a step back from.
Just to say, those puts are now up 200%. Again, we're fully out, but they are flying now.
At the overall picture, which is one of tightening credit conditions, and that's going to restrain economic activity. It is restraining economic activity. So that's how I would look at it.
And how is that informing your outlook for setting policy?
So I think that is an expected result of tightening interest rate policy, is that bank credit conditions bank lending conditions would tighten as well. And so the question is it more effective this time because of what happened in May? I just don't think we know that. I think we're looking at the current data in GDP, and we're seeing strong spending, we're seeing a strong economy, and it's made us confident that we can go ahead and raise interest rates now for the third time since the March events. It seems like the economy is weathering this well, but of course we're watching it carefully.
The key recent things said are
expect to continue to do that.
When Jerome Powell said, I don't see inflation back at 2% until 2025, that's
Chair
key,
Powell.
and
Thanks
there's
for
also
taking
a
our
lot of
questions. Megan
uncertainty
Casella
about
with
the outlook
I
to the
wondered
next
on
meeting,
wages,
let alone
if you were
next
at all
year.
concerned about any inflationary impact of wages now outpacing inflation, which is likely contributing to the boost in consumer sentiment and the continued strength of the consumer that we've been seeing.
Well, wages in excess of inflation means real wages are positive. Again, that's a great thing. Of course, we want that. We want people to have real wages, but we want wages to be going up at a level that's consistent.
Again, these options are moving quick. Those the puts are basically back to where we got out, so they're up at about $450. So just as a heads up.
Period of time, we don't really think that wages were an important cause of inflation in the first year or so of the outbreak, but I would say that wages are probably an important issue going forward. Labor market conditions broadly are going to be an important part of getting inflation back down. And that's why we think we need some further softening in labor market conditions.
This goes sort of to the balance of risks question, but you mentioned at the start how you're keeping an eye on consumer activity and whether there might be some sort of a rebound there. And I'm curious what the Fed's explanation would be to families if further interest rate hikes start to hit the labor market, start to drive that sentiment back down. What's the message there of why you continue to keep rates elevated or to raise them?
Well, we have a job assigned to us by Congress to get inflation under control. And we think the single most important thing we can do to benefit those very families, especially families at the lower end of the income spectrum, is to get inflation sustainably under control and restore price stability. We think that is the most important thing we can do now, and we're determined to do that. And I would just point out that the people who are the most hurt by inflation right away are people who are on a low fixed income, who, when you're talking about travel or transportation costs, heating costs, clothing, food, things like that, those, if you're just making it through each month on your paycheck and prices go up, you're in trouble right away. Even middle class people have some resources and can absorb inflation. People in the lower end of the income spectrum have a harder time doing that. So we need to get this done, and the record is clear that if we take too long or if we don't succeed, that the pain will only be greater. So that's how I would explain what we're doing.
Thank you, Chair Powell. Simon Rabinovich with The Economist. You had said last month that this meeting this week was going to be a live one. In the event the market had assigned a roughly 99% probability to the rate move that you announced today, the decision was, of course, unanimous. And the statement was basically unchanged from last month. So may I ask, to what extent was the meeting actually a live one? Was there ever any doubt over the past 2 days about what the decision was actually going to be?
Well, was there doubt? Look, I would say there's a range of views on the committee, and when you see the minutes in 3 weeks, you'll see that. There's a range of views about what we should do at this meeting and what we should do at the next meeting, and it's a process that we go through. Many times when we go into a meeting, the decision is not, fundamentally in doubt. Nonetheless, we have the meeting, and some meetings are less uncertain than others, and I'll just leave it at that.
Evan Reiser, Market News International. Thank you, Chair Powell. Financial conditions have been loosening at a fairly steady clip in recent weeks, the dollar, the stock market, et cetera. What does that mean for the Fed in being sure that inflation will come down to target?
So we monitor, of course, financial conditions, broad financial conditions. You're right, it's the dollar and equities, and we're of course very focused on rates and our own policy. We're going to use our policy tools to working through financial conditions to get inflation under control. The implication is, we will do what it takes to get inflation down, and in principle, that could mean that if financial conditions get looser, we have to do more. But what tends to happen, though, is financial conditions get in and out of alignment with what we're doing, and ultimately, over time, we get where we need to go.
If I could also ask about the SEP from June that showed rate cuts. Do you expect the Fed to cut nominal rates next year while also continuing QT?
So that could happen. The question is, is that consistent with? So if you think about both of them as normalization, imagine it's a world where things are okay, and it's time to bring rates down from what are restrictive levels to more normal levels. Normalization in the case of the balance sheet would be to reduce QT, so or to continue it, you depending on where you are in the cycle. So they're two independent things, and really the active tool of monetary policy is rates. But you can imagine circumstances in which it would be appropriate to have them working in what might be seen to be just different ways, but that wouldn't be the case.
Let's go to Kyle.
Thanks, Chair Powell. Kyle Campbell with American Banker. I have a question about the discount window. I'm wondering if since the bank failures of the spring, if you've seen signs that banks have taken more steps to be proactive in assuring that they're ready to use that facility if they need to. And if you have any sort of thoughts on whether policies might be appropriate for making sure that banks sort of test regularly to show that they are prepared to use it? Thanks.
So that's a very important thing, yes, and yes to both sides of that. Yes, banks are now working to see that they are ready to use the discount window, and we are strongly encouraging them to do that, banks broadly. We did find, as you know, during the events of March, and that that it's a little clunkier. It can be a little clunkier and not as quick as it needs to be sometimes. So why not be in a situation where you're just much more ready in case you need to access the discount window?
Let's go to Mark Hamrick. Mr. Chairman, Mark Hamrick with Bankrate. You've talked in the past about getting the housing market back into better balance, excuse me, and also that the market might have bottomed. Where do you see that situation and balance, or lack thereof, right now, particularly with the constrained inventory of existing homes that might otherwise be coming onto market at a time when existing homeowners are reluctant to move? And of course, all of that happening with the 30-year fixed rate mortgage still around 7% on the heels of Fed tightening, and with what you're talking about, tightening industry lending standards. Are we getting closer to balance or farther away? What's your sense?
I think we've got a ways to go to get back to balance, really for the reasons that you talked about. With existing homes, there are many people who have low-rate mortgages, and whereas they might want to sell in a normal situation, they're not going to because they have so much value in their mortgage, which means that supply of existing homes is really, really tight, which is keeping prices up. On the other hand, there's a lot of supply coming online now, and there are people coming in. A lot of the buyers are first-time buyers coming in at buying it with these relatively elevated mortgage rates. But I think this will take some time to work through. Hopefully more supply comes online, and we work through it. We're still living through the aftermath of the pandemic.
We'll go to Nancy.
Back in low on the S&P.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Russia has pulled out of an agreement allowing shipments of grain safe passage through the Black Sea, and alternative routes at this point could be closed off. Just wondering, how could that contribute to higher food prices and inflation generally, and how closely are you watching that?
We are watching it, of course, very closely. And you're right, the withdrawal from the Black Sea Grain Initiative does raise concerns about global food security, particularly for poorer countries that import a large share of their food. Grain prices did go up on this news, but they remain well below their peaks of last spring. And the moves that we've seen so far, I would say, are not expected to make a significant contribution to U.S. inflation. Of course, we will be watching that situation carefully.
So you don't think it would have a big effect on Fed policy at this point?
You wouldn't say so, looking at what we know now.
Thank you.
Thanks very much.
Okay, there we go. There's the end of the conference. So, big moves. Again, ended up paying off. It did take quite a while. Again, obviously, we did talk about the pre-trade FOMC trade opportunity. That never showed. We didn't trade that. So then we were just forced, or only looking to trade the after FOMC release, which is looking at the options, waiting for a 50% at least decline in price, and then playing it against the direction it moved. So in this case, we looked to play the puts because obviously the reaction was strong. We went to the upside, looked to trade puts to the downside. As we push down, again, a lot of times we end up getting that fade or at least a pullback. And if you get a good entry on the options, you can just profit on the pullback. In our case, our entry wasn't actually great. We probably got short about here. By the time decay fit in, we only went break even about here. And then we got out most of our profits around that VWAP. So, we definitely left a lot of money on the table by missing a good entry, and that definitely left a lot of money on the table by not getting out perfectly. So again, this is something we will go back, reevaluate, try and improve for next time. How can we get that better entry? How can we get out better? And see all of this, because one thing I was noticing today, and I'll have to see if that's a common appearance, is look at the top. It was a strong move. We kind of got to this top, and then we hesitate there for about 5-10 minutes. And then the same to the downside. That downside move was very strong and predictable. And then again, we came into this consolidation, and then maybe that's where we take the profit. So obviously we'll be researching on how we can improve our trading opportunities on these releases. And we'll see how that goes. But the conference is over. Not much else to look through. Didn't divert too far from expected and from what he was saying. The only thing I guess was quite key, and I think is the main reason we sold off, is Jerome Powell doesn't see inflation below 2% until was it 2025? So still quite a long time off until we can get back to the Fed's targeted rate. But that is the stream. That was FOMC conference statements and the Fed rate. So I hope you enjoyed the video. Hope to see you next one. And again, we are live daily. Peace.